We are going to have one more panel here before lunch. Thank you everyone for sticking around. There's a great topic to end right before lunch. What keeps liquid fund managers up at night? It's going to be moderated by Christopher Solarz, and I'll give it away to the panel here.
Hello, hello. Thank you all for being here, and thank you to the Thai for hosting us. What a lovely day so far. What a lovely week so far. We have an exciting panel. I'm very honored to be here. And I would love to maybe just start down at the end with Melvin. Could you give us 2 seconds on your background and your firm?
Yeah, my name is Melvin, CEO of QCP. We're based out of Asia. We're Asia's leading digital asset partner, and we do a lot of Bitcoin options as our main business.
Thank you. Justin?
I'm Justin, head of trading at Polychain Capital, and we're a crypto native asset manager.
Hi, I'm Travis Scher. I'm co-founder, managing partner of a crypto investment firm called North Island Ventures. We're based in New York. We do both early stage venture investing. We also have a crypto hedge fund.
Hi everyone, my name is John D'Agostino. I'm head of institutional strategy at Coinbase.
And my name is Chris Solarz. I'm the CIO of digital assets for Amitis Capital. We are a crypto fund of funds seated by a family office. So without further ado, my panelists have offered to humor me, and we're going to do a lightning round. I have 5 quick questions. Maybe we'll start with you, John, and go right down the line in lightning fashion. I think it'll be fun to just do some big picture crypto questions to see where everyone's at, see who is the most bullish on the panel, who is the least bullish. John, we're going to start with Bitcoin price in 12 months.
In 12 months, I'm going to hedge and say a TWAP between now and 12 months of anywhere from 175 to 250.
Thank you. Travis?
150,000.
Higher.
Higher. Love it. Melvin?
147.
147. I like it. Well, we have only bulls on the panel. John, second question, Ethereum or Solana?
So I agree with Elon Musk that the most entertaining option wins, so I'm going to go with Solana.
Travis?
Bitcoin.
Justin? Both?
Solana.
Solana. A few hedges, a few Solanas. Here we go. John, favorite altcoin? And this is not Coinbase, this is you personally.
Bonk. Just has a funny culture.
Sure. Travis?
There's a DeFi token called EtherFi.
EtherFi, heard of it? Justin?
Fartcoin.
Melvin?
None.
None. Bitcoin. John, favorite crypto use case?
Yeah, sure. So this I'm really passionate about. So my pet project at Coinbase is to put all of St. Jude Children's Research Hospital's patient art as NFTs on Base. So, and then have their celebrities pimp it out. So the next time somebody spends $4 million in a JPEG, I want $3.8 million going to cure kids' cancer.
Travis?
Self-custody.
Self-sovereignty.
Melvin?
Collateral efficiency.
Okay, I love it. Last but not least, non-crypto, a little bit of fun. What is your favorite recommendation for a binge-worthy streaming series?
Mobland on Paramount Plus, insanely good.
With Stallone?
No, Stallone, no, Mobland. It has a Hardy Batman guy, every great British actor, crazy, phenomenal.
Travis?
This is not applicable to me.
Okay.
We got to throw some comedy in our lives, so Tires on Netflix.
All right. Melvin?
I love food, so Chef's Table.
Love it. Thank you, guys. We're going to get started now. The focus of the panel is on liquid trading, particularly the systemic and maybe the idiosyncratic risks there. But maybe I can just start, maybe John, we can start with you. Like at the liquid trading level, when you're talking to a lot of different hedge funds, what do you see as the biggest themes, the biggest positions, the biggest trades for the liquid crypto traders today?
Sure. I mean, the two major buckets, I'll just say the ones that are working, meaning they're producing alpha and they're generating some interest. We'll talk about how hard it is to raise capital in a second, but the ones that are at least generating meetings to raise capital really falls into 2 broad strategies. The market makers, the dominant market makers, and we're starting to see, like, I was around in the early days before Citadel when Virtu was called EWT, and like it was just a crazy free-for-all, and you started to see the consolidation of the folks who could get the pipes in place faster and hire the better PhDs. I think we're starting to see the higher quality market makers consolidate. They're starting to professionalize. So that's one large stream. So Delta One, whatever you want to call it, market making. And then I think you still have at smaller scale the directional guys who are what hedge funds are supposed to be, and hopefully they have more higher upside capture than downside capture.
Sure. Travis, what are the biggest liquid trading themes you're seeing?
So yeah, what we do on the liquid side is long-term fundamental investments, and I think firms like ours, funds like ours, are, heavily overweight the large cap assets right now, and I think, that's a function of the fact that some of the largest, most established crypto assets have moats, they have brands, and they've performed generally much better than the longer tail infrastructure tokens. Where competition, I think, has been much fiercer on a few different fronts. I think there have been points in the last couple of years where meme coins have done well, and firms like ours, not ours, have gotten involved there, but that strategy's also suffered. So, I think if you looked at the portfolio composition of funds like ours, it looks pretty dull today, but, long term, I think there's many opportunities in the longer tail.
Justin, how about you guys? What are you seeing on the liquid side?
On the liquid side, I think there's a lot of interest still in token launch platforms and launch pads. Something like Hyperliquid's Hype and Pump Funds Pump, and even John's favorite Bonk token. But there's still significant interest in DeFi tokens, I would say, anything that is revenue generating and quote unquote token accrual, and protocols that are buying back their own tokens. But obviously, I think what's hot right now is crypto adjacent equities and these pipes and digital asset treasuries buying tokens, and there's a lot of pre-positioning before these treasuries scoop up and announce what token they're play on.
Certainly, that's been a big theme. It's been a topic we've been discussing for 2 days. Maybe we'll get into some of the risks there a little bit later. But Melvin, last but not least, what are you seeing on the liquid side?
Yeah, I think we're seeing quite a fair bit more people get into the option strategies of things. Relative vol apps are really coming through. I think that's a very natural progression. But of course, like Justin's saying, digital asset treasury companies are just breaking every hedge fund, by just going long beta and just smashing everything. So I think people who have got good strategies, systematic and thoughtful ones are certainly not performing at this time.
Maybe I can dive one level deeper with Justin and Travis, because you guys are running liquid funds. And perhaps the elephant in the room this year is that Bitcoin and listed equity, crypto-related equities, have done super well. And altcoins are still in a bear market, right? So the man on the street thinks crypto is doing well because we see digital asset treasuries, we see Bitcoin at an all-time high. But really under the hood, for anyone picking tokens, it's been a bear market for, going on 4 years. So maybe you could talk a little bit about that. How are you thinking about managing these tokens when it's been very challenging to have real fundamentals emerge from tokens themselves, right?
Yeah, it's definitely a challenge. I mean, for us in our liquid fund, Bitcoin has been by far our largest position for several years. I think we're fortunate that our LPs trust us enough and think on long enough time horizons that they're comfortable with that. There's many LPs who would say, why would I pay you as a hedge fund manager to have, such a large Bitcoin exposure? And our view has been, well, that's been the best risk return for the last few years. It's not likely to be, it's not guaranteed to be the best risk return, every year over the next 10 years. And so our portfolio construction is going to change. But yeah, I think that, outperforming Bitcoin has been near impossible for liquid funds over the last 2.5 years since, the beginning of 2023. And, I think that is one of the reasons that, not the only reason, but one of the reasons it's been quite challenging for liquid funds to raise new capital. There's not a lot of new capital coming into liquid funds. But yeah, it's been, if you haven't had a Bitcoin exposure on, it's possibly been a tough few years.
And Justin, how are you guys thinking about being, almost a value fundamental investor in an asset class that has really been driven by narratives, right? It's so hard to be a token picker for these past few years.
Yeah, selection is definitely hard, and for most of us liquid fund managers, yeah, beating Bitcoin is hard, and LPs will definitely complain. If you're just going to hold Bitcoin, might as well hold GPTC because that's just managed Bitcoin as well. But Bitcoin, you kind of have to use as your cash, essentially. If you're not deployed or if you're not exposed to the market, then what are you? You're going to have to pick some other higher beta token, which we haven't been properly compensated for. So if we're trying to track the benchmark as closely as possible, you do have to hold it. But if you're going to try to beat Bitcoin, we have to deploy it at some times. And you scale up and down of how heavy you are on at least not losing to the benchmark. So.
Yeah, I talk to a lot of different liquid trading funds, and my best recommendation always is to stay 100% long the market in digital assets, but do that exposure through Bitcoin as cash. Maybe strategically you might have an overweight, but in general, I love when it's 100% net long using Bitcoin to make sure they get that full exposure, because it's so hard to keep up these past few years. John, you've talked to a lot of managers. How do you see this almost existential crisis developing that many of the token funds are unable to keep up?
Well, the first thing to say is it's not entirely your fault. The irony of all this is that the capital formation process that crypto is meant to replace, this broken capital formation process, you're subject to that, unfortunately. You're raising in fiat, you're raising through the traditional hedge fund investor network, and that system's just broken. It used to be, and again, not 20 years ago, even 10 years ago, if you were putting up asymmetric returns, you were doing what hedge funds are supposed to do, minimize your downside capture, get 0.8, upside capture. There was a system of investors, there was a machine of investors like Mitchell over here who would find you. Even if you were trying to stay quiet, you'd be uncovered faster than if you took your HR lead to a Coldplay concert. Like, that was their job, was to get to you. And so the problem at that point was, if you really were that top 1% or top decile, the problem was like, how do I manage my incoming capital relative to how quickly I can scale? Those days are gone. BTIG told me that over 95% of the hedge funds under $300 million across every asset class have not raised a single dollar of new capital in the last 12 months. So that's just something we all have to face. Right? The capital formation process for liquid funds in general across all hedge funds is fundamentally broken.
Wow, it's very true. I think we're at this transition moment. We always hear the institutions are coming. The institutions are coming. Have you guys seen that? Travis and Justin, you guys are managing institutional portfolios. I'm sure you have a lot of contacts with institutional investors. Are they coming? Where do you see the next wave of investment on the institutional side?
I think that most institutional LPs, at least if you're talking about, endowments and fund-to-fund platforms, entered the space years ago. And some of them had good experiences, and some of them had horrible experiences. But most of them are nonetheless very cautious about crypto today. And I think, some of that has to do with maybe returns and DPI on the venture side or lack thereof, and volatility and news. But I mean, to be totally frank, I think a lot of it has to do with basically, promises that were made by venture fund managers 5 years ago about, ways in which crypto was going to transform the world that simply have not materialized. And I know a lot of the most, some of the most sophisticated LPs in the world that we've spoken with said, X years ago, fund managers A, B, and C told us that this was going to happen. We told our committee this was going to happen. We gave them money. Maybe they've done well. Maybe they haven't done as well as hoped. But in any case, none of this happened. And so I do think, in that realm, there's trust that needs to get rebuilt. And I think, the industry has a habit of really shooting itself in the foot in the long term by overhyping things. And there's signs of that again today in different parts of the market. At this point, I just kind of expect it to continue in some way in different forms all the time. I think that, when people say the institutions are coming, they mean many different things. If we look on the technology side, they are coming. If you look at, financial services, you've now got BlackRock, Robinhood, and Stripe making serious moves into the space. And for us as liquid fund managers, that's very exciting because I think that's going to expand the investable universe in a variety of ways. So I'll stop there.
Justin?
It's definitely, I think it still is coming in. It's slow and small. I think the interesting, what's happening is investment committees are probably slowly turning the page on allocating to this asset class, just in a very small size, particularly pensions and probably 401ks that have poor asset liability management. They're playing a lot of catch up. Another hidden thing is really all these pipes going on. Where is this capital getting formed from? And there's a lot of interest in buying these wrappers with institutions that can't just hold the token outright. These wrappers are very attractive to them, I think, and they're just buying it through these shells.
For sure, and I want to get there to DATs and the risk and perhaps systemic risks this implies for crypto. But maybe one last question, John.
I don't want to be entirely negative, so I do have a positive side to this. But Melvin, did you want to say something? You good? So I think we all agree like the market for raising capital for liquid hedge funds is broken. It's very, very difficult. Here's the good news for crypto funds. It's not going to evolve like traditional hedge funds where we fast forward 5-10 years and you've got like $55 billion crypto fund. I don't think that's a few will grow, a few will get there, but I think for the smaller ones, you can produce really outsized returns, right? So banging out 40% on 200 million is just as good, especially if you start recycling your own GP capital. I see a lot of medium-sized prop shops in the next 5 to 7 years because the ones who really can outsize returns will just start investing their own GP capital in. They'll gradually have a smaller LP portion, and that's a great life. That's a phenomenal business. The other thing is we, crypto hedge funds, have allowances that TradFi don't. So, for example, like there's lesser requirements for governance. You still have to be at a bar, but lesser than an equal size equity long short fund. You can do venture, you can do liquid and illiquid in the same pooled vehicle. That's unheard of amongst traditional hedge funds. So I think if you're willing to just sort of change your mindset a bit about what I don't necessarily need to produce outsized returns, raise $5 billion, hire 60 people, have 10 offices. I can be really, really effective on a smaller, leaner team, managing maybe a suboptimal amount of capital than what I imagined, but I can do it really, really effectively. The last option is, and some people come to me and say, I want to start a crypto hedge fund. I'm like, you're not going to raise money. You've got these amazing managed account platforms now. So you can go, if somebody comes to me and says, I want to start an equity hedge fund, I'm like, no, you don't. Go talk to Izzy. Like, just work for Izzy. It's easier. There are options for people who don't want to struggle and build that business. They can go work for some of these great managers. So it's possible to build a vibrant trading business in crypto. You just have to change your expectations from what the prior generation saw that path.
I'm actually quite bullish on liquid funds as well for a slightly different reason. When I look at all the money that's been raised in digital assets, it's probably about $100 billion over the past decade. But by a magnitude of 4 to 1, that's been raised in venture, right? Because 8 years ago, 5 years ago, it was much easier for any investment committee to approve a 10-year lock vehicle where you don't get to see the volatility, you don't have to mark to market. That was kind of last cycle. But when I think about what happens in the traditional markets, there's $5 trillion worth of hedge funds. And on the venture side, it's probably about half. It's about 2 to 3 trillion. So in traditional markets, we have a 2 to 1 of liquids being bigger than venture, and in crypto, we have 1 to 4. So I see the marginal dollars kind of following in line with what traditional markets have done, and I don't think that means the end of venture at all. I think it will continue to grow as well, but I think we'll see more marginal dollars into liquid funds, which is very, I think optimistic because it's still a very, very small sliver, just 20, maybe $30 billion total. If you add up all of the liquid trading funds, long biased, that's just a fraction of the $4 trillion liquid crypto market, right?
Yeah, we've definitely seen like crypto VCs come into the liquid space just because they probably got tired of writing checks and there was nothing quality to invest in, and there were crypto plays to be making in the token area. It just was a longer term hold, and it's harder to underwrite, I guess, for a venture team, but it was still an activity that was in front of them.
Totally.
Melvin?
Melvin?
I think one of the things that's changed in the last 7 years has been we've gone through a whole set of interest rate cycle. And I think let's not even talk about ventures. We're talking about private equity, right? Private equity today, they're struggling in a very massive way because, the capital markets have kind of dried up, right, for exits. The sales are not happening. The returns on the DPI is not there. Investors are getting nervy. So I think it's all part of maturation. And if you think about what the traditional side have been going through, that maturation is exactly what we're going to see on the digital asset side, which is, the growth is not going to outstrip inflation. And running a 10-year position, I think running a liquid strategy on top of it, it's going to be more valuable because the opportunity cost has really been a bit too much if you think from a private investor and lockup, right? And then we have issues with continuation funds, secondaries. I think these are some of the things that really point towards what you're saying, a shift in the mentality of others.
Exactly. Thank you. Maybe I can shift to the real meat and bones of this panel. It's going to be the systemic risks inherent in liquid markets. And I would love to give each of you, a minute to just talk about, from your perspective, what kind of keeps you up at night. John, what do you think are the biggest systemic risks to this?
I don't like it when people who don't trade actively comment on market dynamics. I'll let them talk about that. I really do think it's the business risk associated with building these businesses and the enormous undertaking and the challenge of raising capital and the challenge. It's funny. Like I always said this about equity long short managers. Like they're really good at critiquing management companies, but they're horrible managers themselves. And it's not their fault. Like they're a trader who wanted to be who just woke up one day and has to do HR. And these companies tend not to have tons of employees, so the name on the wall tends to be also the CEO. So I think really understanding the business risk and the governance overhang, and yes, we're moving into a kind of friendlier SEC, CFTC, but still, generally the only growth area on Wall Street is regulation. So don't expect major pullbacks in the cost of running a hedge fund and the agita of running a hedge fund. So I think that to me is fine. Recognizing that and maybe even hiring that person or empowering that COO person to actually be a real leader in the organization. I think that's going to kill more high-quality crypto hedge funds than returns.
Travis, what do you see as the systemic risks right now?
I mean, the obvious one is these digital asset treasury companies.
Let's talk about that.
I think that, I am personally not really a fan of these things. I'm not a believer in these things. To me, it kind of feels like if SPACs and ICOs had a baby, and there's a glut of these things coming behind the scenes. These premiums to NAV are not going to persist. It's really a confidence game, and at some point, sentiment's going to shift. And, the way that'll affect the markets is, for now, there is, let's call it temporary demand to buy some of these assets. I think you've seen the run-up in Ethereum in particular. Once these companies are not able to raise money, that demand will abate. The pricing chart will reverse. I think at some point, many of these things will flip to discounts to NAV, and it's not going to be catastrophic. It's not a leverage crisis that's going to lead to cascading failures. It's going to be quite messy. Honestly, for us as a firm, it might be very interesting from an investment perspective when these things flip to discounts. It'll look something like what happened with the Grayscale products a few years ago, but actually more complicated because you have active managers of these firms who have discretion, and they're going to have weird incentives and fiduciary duties, and it's going to be shareholder pressures in various directions. So, that's top of mind this week, that's for sure.
But could it be much simpler than Grayscale? GBTC because these treasury companies can sell their Bitcoin to buy back their shares, right? So that's part of the infinite money glitch theory that they can self-regulate there, right?
That's true. It might be. I don't think Michael Saylor, for example, is going to sell 1 penny of Bitcoin. That's probably the one where the premium is most likely to persist, but assuming it doesn't, I don't think he's going to sell 1 penny. As for these others, like, sure, but, if they go down that path of doing buybacks to get it to 100% of NAV, if that discount doesn't close, all of a sudden these wonderful companies they've assembled become leaky buckets, and then they've got nothing left. So it's going to get funky.
For sure. Justin?
I kind of would agree with what John said. It's all about business continuity, worried about risk of ruin, headline risks such as custody risk, security risk, legal risk, regulatory risk, and even counterparty risk. So what we try to manage the most is key management at the end of the day, knowing where your assets are, who has them, are they safe, and really having a good roster of partners, trusted partners for both custody and trading, selected counterparties that can actually execute well for you and settle immediately. And I think what we've learned from previous cycles was, overextending yourself with various counterparties, whether it's for leverage trading, lending, borrowing, and even just too much exchange exposure. So really keeping assets close to yourself, because we never know when things can really blow up, get hacked, or making a poor selection is one thing, like in your investment portfolio, but not being able to play again tomorrow is more devastating.
Melvin?
Yeah, I just want to agree what Justin and Travis said, and I'm going to say a couple of things. One,
What about me, Melvin?
not yet. I'll pick on
Kind
you.
of rude.
I'll
Agree with them and not me.
Yeah, I'll pick on you there. But you can be wrong longer than you have money, and that's one of the simple things about trading, right? It's not about taking that view. It's about understanding whether you're right or you're wrong. I think when it comes to digital asset treasuries and general systemic risk, I see the biggest risk as investor education. The issues we have with trust and etc. is really we're not asking the right questions about what the product really is. Whether you've heard about neutral, delta neutral funds, but giving 50% returns, and you got to ask yourself, is it even possible? But a lot of times we're not asking these questions. Digital asset treasury companies are getting that kind of day in the sun because we're not asking the right questions. What is the business model? Where is the cash flows coming from? I think these are the things we collectively can work at in trying to make sure that we help the public to understand and ask the right questions. So I think as a whole, that still remains the biggest risk, because there will be people who are selling stories, but if you're the buyer of the story, who's to be blamed? GameStop changed the world, and I think we're still living in the GameStop moment for many of us, to be honest. Everyone wants to be in the next GameStop trade. I was in it, but I think that's what the sentiment is. If you get a sense of what's happened over the years.
In a lot of ways, that's what altcoins are, right? They're all GameStop. They have that explosion to the upside, and that's what's so exciting about this space. Well, I got the tip that we are right at time now, so I don't want to hold up lunch, but I want to thank Melvin and Justin and Travis and John, and thank you all.